Investing Insights with Right Property Group, exploring trends in real estate and helping property investors gain financial security.
Oh, g'day, how you going? Phil Tarrant, co-host of Property Investing Insights with the Right Property Group. Reshmi and Phil Kumar joining me in the studio. How you going, gang? Welcome back.
Good.
Going well.
Thank you.
Is it Right Property Group or the Right? Is there a definitive? I've never asked this question before. It's like people always say the Ukraine when it's really Ukraine.
Yeah.
Is it Right Property Group or the Right Property
So
Group?
as far
So
as you're
it's-
concerned, is the,
Yeah.
but it's actually just Right Property.
Just Right Property
Just
Group.
Right Property Group. But when it comes to us personally, it's the Victor and Reshmi Kumar.
Maybe we should call this the Victor and Reshmi show.
my God.
I'm going to be a sidekick guy on the side. And
For the oldies, it's probably the Hale and Pace show, right?
the Hale and Pace show. Yeah, God. So Right Property, it does sound, it sounds better as the Right Property Group. I'm using the Right Property Group. The Right Property Group is my buyer's agent, blah, blah, blah.
There you go. You claim sovereignty.
There you
Right?
go. Yeah. And we're just chatting off air and we'll have some news for some people. I'm going to start buying again and I've given you a pretty decent brief on what I'm looking for, Victor. So
Yep.
we'll be able to have some fun over the coming months as we can interrogate that on the Smart Property Investment Show as you help me find some new assets, which will be quite nice.
So if there's any real estate agents out there listening, help.
Help now, we need to. I was actually going to ask you about that. You guys have been at this for 20 years, I would
25.
say. 25 years,
Yeah.
right?
Very long time.
So you build all this equity with real estate agents and you know all over the place where we've been buying,
Yep.
and it's been shifting over many years. But do those relationships sort of start meaning nothing when the realities of like other buyers agents in the market there probably sort of putting bigger, higher numbers out than you? Have you been forgotten pretty quickly from all those real estate friends that you once had?
Yeah, so a couple of things in there in terms of nuances, right? So one is that with the years of dealing with these real estate agents, they see what we do, see what results we get and how we really are in and out of markets before the data actually catches up. And they eventually become clients, right? So we get a lot of inside intel. But you're right in terms of how they operate is they need to present all and every offer to the vendor. And so if the offer is higher despite where we are in the negotiation phase, they do need to present it to the vendor. So whilst they might not forget us, they are forced to forget us.
So the requirement on all agents is
Yes.
that if there is a higher offer, they always need to present
They
that
need
to
to
the
present
vendor,
it, yes.
irrespective of whether there's a lot of conditions around that offer.
Correct.
So even if they go, yeah, I'm going to pay 50 grand more, but I need a 6-month settlement or whatever, they by law.
By law, they need to present it, and then they can recommend to the vendor whether to go with that offer or not based on their experience, based on their market intelligence, and then it's up to the vendor whether to take it or not.
So despite best endeavours and the equity you have in your relationship with agents and you might be getting first look at stuff, if other buyers agents arrive on the scene and put a higher offer than you in, it's, you know, there's a good chance you'll lose that property.
Absolutely, and there are a lot of parties that come in with no conditions attached to the contract, no conditions attached to the offer, and that's really, you know, dicing with misfortune.
Yeah.
Because
Can't
if
do
the
that.
bank,
You can't do that. It's other people's money we're dealing with. So we just,
there needs to be protection of the buyer in that contract phase as well, right? So you could sweeten it for the vendor in terms of perhaps removing some conditions, but going in all guns blazing with no conditions on the contract, not even a pest and building clause, that does
It's risky business.
it is very risky. Yeah.
So how does it work then? If you've got a say you've leveraged your many years of experience in agent relationships to get first look at stuff, and every buyer's agent talks about sort of getting off market, pre-market properties. You know, so if a real estate agent has a listing, it's on the market.
It's on the market,
It's just pre-platform, right?
Yep.
So I don't want to get carried away too much in the semantics of it. So if you get a first crack at it, you put an offer in. They'll either take that offer or they'll go, well, we think we might be able to get more. We can open it up to the wider market. When other offers come in over it, I'm thinking from a negotiation point of view, it's not the focus of today's chat. I want to talk about sort of finance, but will the agent always come back to you and tell you where the other offers are at, so you can actually make a decision whether or not you want to push up? Or
Okay, I have to step carefully through this
yes,
minefield.
yeah.
They will give us a agent with good relationship, knowing that we will always complete and we would do the best endeavor in terms of that contract phase. They will give us a indication. They ethically can't really tell us where the other
so
buyer
there's
is
no
at.
obligation on behalf of an agent to tell you where the other buyer
No,
is.
unless it's an open auction.
Open auction. However, and this is where some of the criticism comes from real estate agents, is that they'll say, "Oh, well, look, I've got another offer." You go, "How much?" And I go, "Well, it's above what yours is."
Yeah.
Then you say, "Well, where do I need to be?" This where people think real estate agents are just magically making up offers to try and increase price points, right? And I don't think that happens, does it?
We'll leave that one
we'll
alone.
Leave that one alone. So you really, in many ways, you're bidding blind. So this is the point of whether you're using a buyer's agent or not. You need to really understand the value of the property.
This is the art.
That's the art. So really understanding it. Are you seeing people go over on properties now, particularly buyer's agents, because they may have this sort of, contingent client pool of people that they need to deliver properties to? Is that happening?
That is happening. There are some really good buyer's agents out there, no doubt. But as a fledgling industry where there's a lot more new players coming in, a lot of this is being now transaction-based as opposed to solutions-based. So we are seeing a lot more of this happening where our maximum price that we'd be willing to pay for an opportunity is blown out of the water by a newcomer coming in paying way more for the same thing.
Yeah, that's a challenge, but I imagine it just means you're finding new markets then before
the others. Yes.
Before the others get in.
Yep.
That's now the art, isn't it?
That is the art.
Really understanding it.
Yeah, or finding the in markets within the market.
The in markets within the market.
So this is where recognizing the actual opportunity on the property, as opposed to just buying, by volume in an area, and matching it to the client to make sure that it actually fits in. And we're not just buying for the sake of buying. It's actually a purchase is getting you closer to your goal and adding to your wealth, as opposed to adding to the number of properties you're buying.
Yeah. Okay. It's getting more complicated now.
It is.
Investing is very complicated.
It is complicated.
If you want the results, yet it's very simple. If you want to keep it, simple, you just stick to the rules and know what you're doing, and be guided by the person with experience way more than what you have. So,
and that's the reason why you use an advisor, and an advisor isn't just it's just not the buyer's agent's part of the advisory. It's your accountant, your plan, and all this sort of stuff.
The team around you.
The thing is, I think with this industry being new, people just got to know the word as a buyer's agent, and everybody, just like any real estate agent, as a selling agent, listing agent, there's a buyer's agent, but that is just to find somebody a property. I look at it that's pretty much what they do. What we were doing right from the beginning was focusing on finding the right property to build a portfolio. And buyer's agency is one service that we provide where we're finding those properties, but our consultancy, which we do with clients, is far different to, it's not like simply just finding a property, and anybody could find a property for anyone. And like, people don't necessarily have to use buyer's agents to find a property. They're using buyer's agents to find them a property only because they haven't got the time. But if you just went one step further, and why are you buying? If you look at building a portfolio, then you're buying. It's not just buying for the sake of, I need to buy a property. The reason I'm buying is I want to build a portfolio so I can have a sort of some income stream or something where I can kind of cut back on my time and get income coming from there. So the property that someone would buy for me has to fit in a certain criteria, which will allow me for having that portfolio, giving me that result. But how do you know that is the property I need to be buying? Because you haven't got that experience of investing. You just know that there are buyer's agents out there who will find me a good property. But what is a good property? Buyer's agents just end at that level. If you're building a portfolio, you have to go one step further, not just one step further, like really have to think few years ahead of your time as to what exactly you're trying to achieve, and then what property will get me there. Because each property, each selection that you have is going to it will allow for the next purchase, allow for the next strategy. You need to come back to it. So when I say someone working with a buyer's agent, you have to really be very, very careful who you select, because they can make or break you.
Yeah, and fortunately, up until this point, most buyer's agents have made people. We haven't really gone through seismic shifts in markets where
that's right. Yeah,
where buyer's agents can potentially break people. There has been, to be fair, some isolated incidences where a lot of people got stuck. I think about sort of mining towns, sort of 15 years ago, right, where a lot of that was recommended in by some buyers agents operating that time, spruikers, if you will.
Even going back 20 years when they were buying properties in Queensland, remember? The overinflated prices.
Yeah. So it has happened beforehand where a lot of people have been, and there's still a lot of people holding, negative equity.
Yeah, absolutely. They still are, even with that increase.
In some mining towns, right? So they've been broken.
So the good thing is we came into with the high interest rates, and then with COVID, the interest rates were down. So pretty much any property any buyer's agent would get for somebody would be in that. The atmosphere is such that that's what's happening. It's going to be. So how do you say that it is because of the result of the buyer's agent or what is surrounding?
I think we are in that phase in this industry of where we're just before dawn in terms of, the vision is not that clear. The data is not that clear. It's just before sunrise. If you can picture that, and the reason why I say that is that we've come in. If you look at the last 5 years, we came into very low interest rate climate, and at the same time, people were looking at changing careers and all, because they had a lot of time on their hands. So we then had this fledgling industry that's absolutely blossomed, right, in terms of more and more people coming in. So we've got two very, very big catalysts that is now shaping the buyer's agency market, and it needs to go through its growing phase first before it can settle into a rhythm.
Yeah, and we're still some way away from the rhythm.
Yes.
And I don't mind your analogy. It's it's pre-dawn, right? So it's not far off dawn, but it's pre-dawn. But what happens during this period before, we move into sunrise is it's really going to shape that industry for some time to come. So we've just got to get it right. And I've been chatting about this a little bit, but that's not why we're here today. We're here to talk about finance, and this is part of our special series on Design Your Decade. So thanks for tuning in over the last 8 months as we've been working our way through Designing Your Decade, noting that we introduced the idea and the theme in December of 2024. So already we're not far off September, and
I know.
Looking down the barrel of the end of the year. I have no idea.
17 weeks to Christmas.
Is it? No.
Yeah. Well, at the time of releasing this podcast, we're recording this about a week early.
Did you say 17 weeks till Christmas?
Oh my God.
Yeah. When we release it, it'll be 16 weeks to Christmas.
Yeah. Okay. How did that happen?
Let's not release it, then the time will stop.
No, hopefully.
Okay.
Hopefully it's time. And I still have my frustrations about every time I see you, I go, I've got to be doing more. I always prioritise other things. So now we're back in business. We'll get some stuff done. But all of these, your ability to buy a property and grow a portfolio is absolutely contingent to your ability to secure finance.
Yep.
That's what it's all about. And as we're recording this podcast, some of those reductions or passing on of that last 25 basis point cut has taken place. So, people have a few more bucks in their back pocket with mortgages. Might be a good time to visit your mortgage broker to have a look at that. But I've got 8 points here that I want to run through today, which is related to finance and mainly busting some finance myths. So whether it's misinformation, I don't think it's disinformation. There's a lot of misinformation. Where someone says something and everyone thinks it's gospel and therefore gets promoted and ratcheted and it becomes a norm. And I think there's a fair bit of misinformation in and around finance. And maybe I'm one of those people that might be, inadvertently propagating some of these things. You know, a useful idiot they call them sometimes, right? Where you might be putting out information that you might not know, someone else has said it, and you think it's gospel, and therefore you promote it. So this is important with property and property investment. Is this idea around misinformation? You don't want to be whether it's the advisor you use or the strategies deploy. You've got to stress test stuff, but particularly when it comes to finance. And the first one here, Victor, around busting a finance myth. And obviously this is as you design your decade, as you go about crafting your portfolio over this period of time, is around cross-securitization or cross-collateralization. Most people will tell you, and I've spoken about on this podcast, we've probably spoken about it, saying you should never cross-collateralize. But there are some exceptions to the rules. So this is when you start getting quite sophisticated in your financial strategies.
And just to put color to this, there are rules and there are always exceptions to the rule that prove the rule, right? So let's talk about, first of all, cross-securitization and why it's not a good thing, right? Because there are two sides to the coin, and I want to flag that very early that there is definitely two sides to the coin. And we need to take a very informed approach towards finance, because finance makes or breaks your portfolio. So if you're looking at cross-securitization and the reason not to do it, especially as you're building a portfolio, if you're buying just the one property, it doesn't really matter how you get the finance at the end of the day, right? But if you're getting into that 5% cohort that's going to be owning more than 3 investment properties, this is something we need to take into account. So if we cross-securitize, and let's say we look at stats, most people sell their investment property within 5 to 7 years of owning the property. And if you're selling, then if the valuation of the other property that's in that loan as well does not stack up, but potentially if you're in 2 different states, these profits from the sale you would need to pay into the other loan, and back into the loan, because the valuation hasn't stacked up. Yeah. Now, in the yesteryears, we were talking earlier about how Queensland market performed, particularly if for those that have been around long enough, areas like Robina, areas like Caboolture, where people used to come down and do seminars in Sydney and Melbourne and say, we'll get you a house and land package, and we'll do the finance. It's not going to cost a cent out of your pocket. Everything will be 100% funded by the bank. And what they used to do is securitize the home with the house and land package, so it was just the one loan. When it came time when they ran into trouble and needed to sell, because they had actually overpaid significantly the properties that they had bought, to sell that they had to then actually increase their mortgage on their home in comparison to when they started out. So that's the negative side of it, right?
So that's an issue if you end up in negative equity on those properties, and therefore you may be stuck and you might not be able to realise the equity in the other property because it's going to be contingent to what you have over there.
Correct.
Yep.
You've got to think of cross-securitization, that is there as a tool. And is it a tool you need to use or you don't need to use based on your circumstances? And it will be on the property. If the property is the wrong type of property, it's not the right property, then it won't work for you.
So this is cross-securitization is really this secret tool that you have in your bag that you only pull out when you absolutely need it, right? So a couple of examples. Now if you're looking at a portfolio and you've come to a point where the interest rates are fairly high in comparison, but you don't qualify for finance elsewhere, you could go with some banks that use a dollar for dollar refinance, provided each property is at 80% loan to value ratio, and they'll use that commercial rationale to say you're paying $2,000 more per month with this lender. We will refinance you into our product and you'll be paying $2,000 less, and therefore we don't need to fully qualify you as to whether you can take this loan. So if you came in just as a pre-approval, you won't qualify, but refinancing the portfolio, you would qualify based on that scenario. Yeah, and in that case, where cross-securitization comes in is if you've got properties in different states and one of them doesn't come up to 80% loan to value ratio to because you bought it recently, there is the advantage of actually cross-securitizing it for the next, say, 1-2 years while you're waiting for the value to go up, so that you have actually now got a lower operating cost. Now, this is something that one of the brokers we work fairly closely with, we discussed a scenario with a client where all of their property standalone was okay at 80%. One of the properties that we had bought recently was in Victoria, so therefore it wasn't quite at 80% of the value that the bank needed. And if we left it alone, the cost was going to be $1,800 a few dollars per month extra. Whereas if we stuck it together with another property, which was in, I think, from memory, Queensland. So these two properties are now cross-securitized, but it reduced their operating costs by $1,800, right, a month. That could be a holding cost for another property, or it could be a holding cost for lifestyle, right? It just gives you that breathing space, and we've got a clear strategy to say, okay, in a 2 years' time, we'll go back, revalue, and separate it. And the mortgage broker then understands that's the strategy, and that's a good reason to cross-securitize.
And these are very specialized things. It's not something somebody would out there would do it. It's you really have to understand what you're playing with.
Yeah.
Yeah.
Oh, yeah, absolutely. So what you're saying there, two investment properties, say one might be at 60% and cash flow positive, one's at 90% cash flow negative, it's costing a lot to hold. So you're making positive income here, you're making a loss over here, so you're just rebalancing it so that both
for the time being,
both at 80 until this is standalone, right? Then you just refinance both and
correct,
and get rid of the cost.
Which gives you a significant interest rate reduction as well.
So rather than getting the positive income over here that you're paying tax on, you're porting it into covering some of the costs.
No, so the loan amount remains the same.
Yeah.
But it's just that we've now reduced the operating cost.
Yeah, so you push some of the loan over to the other side.
Yep.
Yeah. Okay, so it is pretty specialised stuff.
Yeah. And then, of course, if we, as we're talking of here, if we have a specialized property, right, where the traditional approach with a bank could be that it's only 60% or 70% loan to value ratio, we could see, cross that property with another property that the bank's willing to give a lot more in terms of loan to value ratio, so that we can then value add to the new security. So we're talking, say, like a block of units as an example. Okay. Yeah. So traditionally, if we've got more than 4 on one title, depending on the lender, you will go down to 60%, 70%. Whereas if you stuck it with another property, did the renovation or value added the new security, then you can separate it at that point in time. So it actually gets you into that market. It gets you into that property. And the third reason you'd cross-securitize is part of what I've done in my portfolio is I've grouped a couple of properties with the lender. Man, the admin work is terrible.
Gosh.
We've grouped a couple of properties with a lender, and what it's done, it's totally paid out a couple of other properties, so it's mortgage-free, right? My debt exposure is still the same.
Yeah.
I'm very safe because I've got unencumbered properties. And the other added benefit now is that now with the loan size being bigger with that lender, I'm getting much, much deeper discounts.
Okay, and they're all together, and no doubt the assets that you pulled and cross-collateralised are probably all growth assets. So
correct.
at a point in time you can refinance them.
Yes,
that's right.
Which we are allowed, kind of getting them out.
Yeah, always have the escape clause.
Yeah, you always need escape. So on that, so that's the point 3. So on that second point with, rather than if you're doing something with a block of units, you might only be getting 65% or 70% versus something with traditional resi at 90. So what you're saying, if you pull those two things together, you might be able to get a blended 80% across both.
Correct.
Yeah.
Yes.
Yeah.
So less money out of your pocket, you're bleeding less equity from the entire portfolio.
Yeah. And interest rate should be sharper.
It's sharper as well. Yeah.
Yeah. So it means that you can sort of operate in that commercial space if you talk about apartment blocks, but on resi,
correct,
resi rates largely. Okay,
Yep.
So this is when it starts. This is when property investment, like, it is simple and easy, but this is when the nuances of sophistication around finance. So so some really good myths are busted there.
So the myth that we've busted is never ever cross-securitize.
Yeah.
Yes, there are occasions that you would.
Sometimes you should.
Yeah.
Sometimes you would.
Yeah.
Sometimes it can be worthwhile as long as you have sort of contingent
exit around it. Yeah. If you can if you see an opportunity and you know that by cross-securitizing doing that, you'll be able to capture that opportunity. Why not? But again, you need to have when are you getting to exit out of it, and how are you getting to go out of it.
Okay, great. Another myth to bust here: buying in a trust. Not taking into account where deposit will come from, getting caught out with stuff with your principal place of residence. This seems to be one of those themes everyone should be buying in trusts at the moment. Is listening to some people out there. Buying in trusts is relevant for a lot of people. Some people, I've bought all my stuff in trust under good advice, but it's not necessarily for everyone.
No,
it's quite a lot around that.
Yeah. So if you look at the shorts and the YouTube videos and the social media in terms of, buy a property in a trust, you've got perpetual lending. I think that is by far the most negligent thing the advisors are doing. And I'll stick my neck right out on this one. I think that it should be raked in front of the compliance guys. Unfortunately, property does not have good enough compliance right now. But if you look at it from a logistic point of view, right? So often when people are starting out and building up a portfolio, and often when advisors are starting out, if I can use that as in inverted commas, if they're starting out, they don't know what they don't know. And you really need to be having gone through at least 2 cycles, taking away the cycle that has emerged out of COVID, right? Because that was abnormal. So normal cycles, at least 2 normal cycles. So someone that's been around for at least 10 years, I dare say, they would be putting their hand up and saying, this is wrong. This is leading up to financial ruin. So if I can bring it, let's forget the trust for a minute. If I can bring it back to say a partner, husband and wife, and they're purchasing property, even though the property is in one name, the money is still coming out of the household, right? Unless you're running totally separate finances. Now, when I bring that into a trust, so the if I can be diplomatic here, the advice out there is that if you buy in a trust, you will have an accountant say that or sign off that this trust is self-sufficient and it can maintain its own liabilities. So bring it back to the husband and wife. We could say that the wife is working and therefore she is self-sufficient and can look after her own debt. So therefore I'm qualifying for finances as the husband, or vice versa. So they're using that same scenario in the trust, but what they're not taking into account is that it actually the negative gearing, if it's a negative property, gets quarantined within the trust. So there's no benefit there in terms of dampening the negative cash flow. But more importantly, we are getting the deposits from somewhere else. Where is the calculation for the repayments of that deposit? We're still getting, by and large, we're still getting it from the same pot. It's just that it's in a different section of your wallet. And if our property is, say, 10K negative, by the time you take your deposits, your closing costs into account, and you then got 10K negative, you're not really getting any tax benefits to dampen it, then you've opened up another trust and you're repeating the same. And you're saying that, yes, you can continue doing this forever. Couple of things will happen, right? Eventually, the regulators will step in and they will say, no, we need to wind this back. And that this has happened in the past, right? Yeah. So if you look at the blended loans where you're able to capitalize the interest on the investment side and all that, that's happened in year 2000. This trust thing was in and around in 2000. They cut it really quickly back then. It's now rearing its head up with the new cohort of people coming in, new thought process, and everyone focused more on transactions. How many properties can I get under my belt? And it will get, at some point in time, rein back in. But more importantly, from a family point of view, you're setting yourself up for failure.
Well, you still got to pay the debt.
Yeah.
You know, and that's got to come from somewhere. And if you can end up with a very significant accounting issue when you're taking money out of your principal place of residence, refinance, and not sort of orientating that the right way to put into a trust. And I know I've spoken to many accountants around this, and a lot of them will just go, no way, I'm not writing letters for anyone. Like
it's actually a false letter that they're writing unless it's truly positive.
And accountants actually have obligations, professional obligations around this. And I know the regulators are actually looking at this and speaking to accountants around it. So it's a big issue, Reshmi.
It's a thing where people have to look at, like, at what level am I involved in my investing? If I'm only buying 2-3 properties or 5-6 properties, or I'm planning to buy more than 10 properties. So where am I as an investor? Where do I sit? And then the decision could be not like from the beginning, like set up trusts and start buying properties in trusts. So, you know, it's not suitable. It's not for everybody. And once you know where you sit, then you've got to really think through as your plan and then at that time you wouldn't be dealing with those property advisors. I am very frustrated when I hear people call themselves property advisors. I'm telling you right now, the quality I see, sometimes we interview people, and the quality I see, I just cannot believe that people think that they are advisors.
And this is one of the greatest issues with this industry, that's unregulated and there's no real requirements around education. It's just one of those, and it's outside of the scope of today. But what I would say though is that when you see on social media someone going, hey, I found a hack to help you buy more houses, use a trust, like, you know, a trust is a very sophisticated financial instrument. There's a lot of second, third and fourth order impacts connected with that. So I'd be very concerned about it. That said though, for the right person, a trust is a great mechanism for operating, investing in trusts or company-based structures. But, you know, doing it for the purpose of trying to buy more, you still got to pay.
You still got to make the repayments, right? So where this has really stemmed from is that most banks have got a simple rule that if your liability is covered by, I think from memory, 1.15 or 1.25 times the repayment requirement by the rent at 80% of the rent, they will disregard that liability. Now they've transferred that into trust, saying, okay, we can get the accountant to say that, you know, this is self-sufficient and it has got, we can take care of all of its contingent liabilities, and that's then become a thing for people to buy more properties.
I've got trusts and certain assets in trusts, and I'll think about one you bought for us some time ago. So one trust has got an apartment block in Launton in it, and maybe another property in somewhere in Queensland, Kingston. And that took a long time, really only the last year or so that it's become
neutral,
like genuinely neutral, like pre-tax neutral. That took nearly 10 years.
10 years,
10 years. You know, and if you're buying property today at 80%, it's not going to be positively geared.
No, because where's the 20% and the 5% closing cost coming from?
It's not positively geared.
It's got a cost attached to it,
If it's a 60% OVR, you might be getting into positive gear territory. If you're buying at 90, it's certainly not. So
this is all marketing. That's why they're all jumping and buying properties everywhere, because people are not really realizing what it is.
So when you work out your holding cost, work it out at 105% of the purchase price, because unless you're putting in cash deposit, cash as in cash from your savings, then perhaps it is neutral or positive depending on how much you tip in. But then that raises another question as to, okay, why are you tipping in all of your money into that one asset, whereas you could multiply it over multiple assets?
Yeah, so again, for a different time. Point number 3 here around myths busted. I think that's a good about buying in trust, but we can do this one quickly. Going interest only all the time.
Can I say something here? Like, you know, this is let's say a new industry, right? People's experience is people advise people based on their experience. So what happens is, I know in the early days, we were like, oh, it should be interest only because you can use that principal money and you hold more properties and all the rest of it. And so advisors at the moment are new in this field, and they haven't had that experience of over 25 or 30 years to see what exactly does happen when you do that. Or how can I make it better for somebody? Because they haven't actually gone through that 2 cycles or more than 2 or the 25, 30 years. So at the moment, they're at the level of should be interest only because you can use the money to do that. But when you go over time and you realize, well, you know what, it could be done better. You know, where we focus or what we can do with that money, or how we can, you know, instead of interest only, we could do principal and interest. And there was another one here in one of the other myths when we come to it, like paying off your investment loans or home loans, the actual home. Which one should you pay first? So we'll come to it a bit later. But what I'm trying to say is, it's the experience of the advisors is what you're getting. You're right. So you, at the moment, if that's what they've done and they know that, okay, this is the way to do it, then that's what they're telling people. And that's what a lot of people know. But people don't know that yet because you haven't had that experience.
Yeah, there is no textbook out there, right? Unless you bought my book, of course, Supercharge Your Property Portfolio. couldn't resist that plug. Is it up there on the shelf?
I think I've got it somewhere. I might have it in my special shelf.
Is that? Or you've just got it as a beer coaster somewhere?
Oh, they're probably holding up the door somewhere, I imagine.
Yeah. So if you look at, everyone talks about investments always be interest only. Yeah. Yes, it's got merit because it reduces your holding cost because you're not paying the principal component. But if you have the ability to hold on to the cash flow of that property that brings, if you went principal and interest, with some lenders, it will allow you a much higher loan to value ratio.
P&I.
P&I, yeah.
Yes.
So if you got P&I, it'll allow you much higher loan to value ratio. So as opposed to say 80%, they may allow you 95%, depending on the preference if you got P&I, right? And there would be, it traps in less of your capital in there. Now, this is, again, a very strategic finance approach where if you're on a very high income, you are able to hold on to the principal component of that repayment, and it's not going to slow you down in terms of further acquisition or tacking away if life takes a turn. The same amount of capital could then be spread over two assets. Might not be the same value, but you're getting into two different opportunities just by simply going principal and interest on one or both of them, depending on your cash flow requirements.
It's a really good point. So you can do the math pretty easy. If you've got a 15% difference in a deposit you need to save because you've gone P&I,
yes,
that's a significant amount of money. Say it's $1 million property, 15% of that is 150 grand, right? So instead of having to save, what would it be on $1 million bucks, you'd have to save $400,000 to $200,000.
Yes.
Yeah, that means you only need to save 50
and you're into the next, right?
You're into the next, we put the other 150 elsewhere.
Yeah, and I know that the thought process is okay. If you're going above 80% paying mortgage insurance, particularly on $1 million one, you're paying about $43,000 in LMI. But this particular finance strategy works for certain professions. Yes.
Well, I want to talk about that because this another myth here, and maybe we can loop it to, is that everyone pays LMI. Well, no. So this would be a huge strategy. So accountants don't pay LMI. I think lawyers can get away with it.
Yeah.
Nurses,
doctors,
maybe
most health professionals get away with it.
So does that mean that you essentially, well, all the rage at the moment is everyone's talking about the acceleration of those 5% loans for first home buyers. So there's no LMI for those people anyway. So you could just use your strategy you just said there.
Correct.
Go P&I, and you think about it. If you need to have $1 million, it's an easy number. But so rather than having to raise $200K deposit, you need a $50K deposit plus closing sold. So that $150K. So if you're paying off P&I at on a 95 land on $1 million purchase, it would be a number of years the principal component that you would pay to get to that 150. So and that's you and potentially two other markets getting the capital growth. So it's a good strategy.
Yeah, and you'd also looking at it from a viewpoint that we're getting into a growth asset, right? So when it goes up in value, whether we're forcing the value or we're using the market to increase its value, we could then always do a internal refi with the same lender, get them to recognize the new value, and it drops your loan to value ratio down to 80%, and you're back onto interest only.
Yeah.
So you might need only hold for a couple of years.
1-2 years.
Yeah.
Yeah.
Get a refinance, 80% interest only.
Yeah.
It's a smart strategy.
Yes.
Yeah, no one really details this. These are the nuances, but
Yeah, that's why you get paid the big bucks.
yeah, sweet. Play the game. Wonder. What podcasters, they should get LMI offsets, I reckon. Someone, I don't think people.
Podcasters, I don't know.
Podcasters,
Yeah,
yeah,
it depends
but
on
it's a
the quality.
profession.
Yeah, it depends on the quality of the podcasters. I mean, some hosts are really, they leave a lot to be desired.
But $43,000 on a
Generally,
that's a lot of money. Right?
Yeah. Now again, this is like any insurance, because lender's mortgage insurance, LMI. Yeah, it is an insurance policy. You're protecting the bank, but like any insurance in life, depending on which provider you go to, in this case, the lender will determine your premium. So with one lender, it could be 43. Another lender, it could be 25. I don't know. I'm making these numbers up, but there are significant differences lender to lender.
So, Reshmi, tell me about this next point here around busting some myths around sort of forward planning with offsets. People get obsessed with offsets and potentially redraws. What's your view?
My view, offset accounts are really, really good. There was an example Victor and I were talking about before coming in here. So, this is where you really need to understand how an offset account works, because people still don't understand what an offset account does. And what were we talking here in terms of the offset, putting money in the offset when you and you're actually not paying the interest, so your repayments are low or pretty much.
So what we were talking about was really planning for life. So if we're about to start a family, or if we're about to change careers, you would go in and make sure that we've liquidated as much of the equity as possible. And people have that thought process that, okay, if I've increased my loan, I'm going to pay more. Technically, yes, but in reality, no, right? So let's say if we just take an example of, I've got $100,000 extra, and I've whacked it straight into the offset account within that with that loan, then you are really not paying any interest. Again, depending on how the offset account is set up. Some banks will only offset 60%, others will only offset 80%, most will offset 100%. So we really need to look at the fine print.
You realise that some banks only give 6% of the offset.
Absolutely. And then you have a limit in terms of the number of transactions you can do off that account before the offset disappears.
Okay.
Yeah. So you need to look at first the fine print. So don't just go blind and say, I need an offset account. Ask how it operates to begin with.
That's a good tip. I didn't know that. I didn't know that.
Yeah.
I thought it was just assumed 100% of it.
Yeah, no.
Because there's many times when we've had clients, either they've sold a property or they've gotten some money. The best way to do it, like when we say when this comes back to setting up your finances in the beginning, the correct way of setting up their finances. So that's where we say if they've got if they are refinancing their home loan, most of the time we say probably get either a line of credit or an offset account, so that can be used throughout their journey so much. So it just helps.
Yeah.
Because you go on.
So if you look at from the offset point of view, thought process being, I've increased my loan, therefore my repayments are going to be higher. So to keep the math simple for me, so let's say we drew down $100,000, and now my repayments are, and we've put the whole thing in the offset account. So therefore, we're not, provided it's 100% offset, we're not paying any interest. But with most banks, you're still required to make a repayment. And the repayment you're really making is the principal component rather than the interest component now. So we really need to look at it from a...
That's assuming it's a P&I.
Yes. Yeah. You can have interest only as well.
Okay.
Yeah, you can have offsets on interest only as well.
Yeah. But in terms of if it's interest only and it's at $1, you don't need to pay. You need to pay the $1.
Okay, so let me relate an incident in my portfolio.
Here we go.
So when you have money in the offset account, hot tip, when you have money in the offset account and you've reached a point where you've got just enough owing in there, which is equivalent to say a monthly payment.
Yeah.
turn off the direct debit. Because what happens with most lenders,
You pay the loan out.
you pay that, it triggers an automatic discharge.
Yeah, I've done the same thing.
Yes.
You got to play the
Yeah.
offset game, right?
Yeah.
It needs
Yeah.
to be enough.
Yeah.
So
Yep.
you know,
So-
and if it's P&I, you know, and this is offset versus redraw, again, it'd be sort of slightly different dynamics. But you know, if you have you can turn off the payments though. You
Yep.
can say to the bank, I don't want to pay any more into this.
Yeah.
You know, and they'll go, okay, no worries. But if you forget that, that's
I know. So we had this where I'd put that in, and the loan actually paid itself out, right?
Yeah.
So there's nothing owing on it anymore. And I walked in the branch one day and said, I can't access this on my net. What's wrong? And she had a look on the computer and said, well, this loan's been discharged. Yeah.
So it means you have to refinance the property to get access to the cash again.
I used the VK charm and I charmed my back way into the loan. But it was a lot of paperwork.
Yeah. I remember.
But the issue also is that if you're always increasing your investment properties to 80% and having that money in offsets, that's great because
It's great,
you know it's got to minimise your repayments. However, you might not actually. It's going to get to a point where you're going to hit serviceability thresholds, and they say, well, you've got too much. Your lending against those properties is stretched, so there's no more for you. So you've got to actually
You've got
start.
to really understand your offset and operate it like a bank. You've got to understand how it works and use it.
Yeah. So if you come back to that 100K example, so we're now making a monthly repayment back, right, which is actually paying the loan down. So we've now controlling a facility which can be our buffer, it could be our deposit for the next one when we come to it, when we need it. And so we've drawn down a whole lump sum and we're paying it back piecemeal without really costing ourselves much, right? Because you can pay it back from the same account. Now, a mortgage broker may not necessarily be able to advise you on an offset account because it's actually a product. So you really need to sit down in front of your accountant or financial planner to actually work out and map out how this would work for you.
Yeah, and there's you know there's software around where you can do long-term mapping on this sort of stuff, and it can work well. But if you're an active investor, having an offset means that you be very pragmatic in your buying capabilities. If you've always got a pre-approval sitting around, it means you can be really dynamic.
That's right,
and then opportunistic. You know, which is a really good place to be. Let's talk about loan portability to bust another myth.
Yes. Victor.
Often a very sort of, you know, confused aspect of it. A lot of people don't think about portability.
Many people, many brokers, many accountants do not know that this is something that can be used as a tool, right?
Don't know that this tool exists.
Yeah.
That's what you should say.
Yeah, true. So we've used this many times in our portfolio, and the time you would use it. So you'd use it when you're not able to qualify for finance and you are liquidating an asset. So how the bank gives you a loan is they're giving you a loan based on your ability to make repayment, your character, and the security, right? So character being now, for in my case, being good looking.
Incredible. Do you remember the 5 C's we used to say?
He's looking fit at the moment, Victor. I was sort of like, you know, you look like a younger man. You know?
I am, right?
It's the
Reshmi keeps
company
me
he
on my
keeps.
toes.
Keep yourself in good nick.
Yeah.
Good.
So if we do you see how they brushed it off? So if you look at loan portability and you're not able to qualify for further loans, but you still want to expand your portfolio, yet you want to take a profit off one of the properties that has done its job, right? And a real life example is one of my clients that I had done a review, and they were planning to sell a property in New South Wales, and this was a $1 million loan that they had on this property. And the property itself, from memory, was 1.8 as a sale price. And they're saying, well, I'm going to be out of the market for the next 2-3 years because I don't have any further income coming in that is above and beyond, even after I offload this asset. So I then got into discussions with them in terms of porting the loan. So when you're selling the property, you don't discharge the loan, you only discharge the security. So that means that you're still paying for that loan while there's no actual security attached to it apart from the cash proceeds from the sale. So generally what the bank would do, and each bank is slightly different, but in principle, generally what the bank will do is retain 105% of the original purchase price, or 105 or 10% of the new loan. So you would have maybe refinanced a couple of times and increased the loan, and they give you a time frame to find a replacement security that is acceptable to them.
Okay.
Yeah. So in this case, what we did with this client was that she offloaded this property, and then I started talking to the broker. So she went through 3 brokers and with nil results. So this is while the property was on the market. Then I said, well, go back to the bank that you are with, right? And this is where you jump in and ask which bank. Yeah. We went through the relationship manager, and I've got emails, narky emails from him saying, here's what our policy says, that we can't do this, right? And it has to be on the day of settlement. We need to be having the new security. Yeah. So now that puts you into a bind, because you now you're rushing to find the next property, right? And cool offs and whatnot. And then I kept empowering this client to go and ask the right questions. The trick with investing is that if you have the knowledge base, you then ask the right questions to get to the right solution. Yeah. And so finally hit on to a person within that bank that said, yep, it can be done. Yes, and you've got 90 days to find a security. So we then found her a house plus granny flat still within New South Wales, which had a far better cash flow and far better growth trajectory, and did not have the heavy maintenance requirements that was going to suck out all of the equity in the property that we were selling. Right. So this is where your understanding of loan portability. So if you can't qualify for loan and you're offloading assets, the thought process, most people think that you're out of the market. Not necessarily. That is a myth.
So you've already got the loan.
Yes. The loan was already there.
This is the irony, that's where the loan is an asset rather than a liability. If you frame it that way, and you could just put it against a new asset, and you would use some of the proceeds of the sale price to pay for the entrance costs into the new property there.
Yeah.
And you got to know what size the loan is, so that will help shape what your budget is for the new property. Yeah. So it makes sense. So I sort of sit there thinking about, is there more paperwork just shutting that loan down and sort of starting a new one, or is it better off?
About the same.
Yeah, okay.
About the same. It just needs a good solicitor or conveyancer on your end, and a good broker on your end who knows what the process is, and then also latching onto the right employee, right person in the bank to then help facilitate that.
Okay. Good. That's learning a lot, Victor and Reshmi. Thank you. 2 more myths to bust here. Pay off non-deductible debt before deductible debt. This is what you're told by everyone. Pay off non-deductible debt, so your principal place of residence, so you're being mortgage free, rather than paying off tax deductible debt.
In the early days, we used to say that too, because you don't know, right? You want to free up the home that you're living in so that nothing can affect it. But as you go along, you gain more experience. You realize, well, this is kind of wrong way of doing this. There's a better way of doing it. And I remember maybe 10 odd years ago when you were asked to speak at a property expo. This was like this is something he spoke about. It was like like a controversial topic back then, and it's like the hall was packed. Like people came in, what the hell is this all about? Like paying off your non-deduct, So this was really
where this stems from, where this myth stems from, is really from first of all our heritage, our yesteryears, in the sense that especially first and second generation Australians, where our parents and grandparents came from the Great Depression, and the banks were those that had loans, and I think 17 to 23% interest rates. Those that had loans absolutely had to scrimp and save and take extra jobs to hold on to their property. And those that did not owe money to the bank, they were smooth sailing.
Yeah.
So the thought process came in: buy off your home first, right? Because it'll be safe. Then you've got the approach in terms of, okay, what's the advice coming from the accountant? And again, this is quality of question that you need to ask. So accountants will come, most accountants, there's some really good accountants out there, property-centric accountants. Most accountants will come from a tax minimization point of view. And therefore, they'll say, pay off your non-deductible debt because we want to maximize your tax. And it has a cycle within your career as well. But if you really look at what we're trying to do in terms of investing, it is to buy back our time. And so if we paid off a loan if we paid off a loan which has got income attached to it, then we're freeing up that income, and that allows us to buy back a little bit of time. And this is now again seeing the other side of the coin, right? So don't go blindly in terms of finance and in terms of building a portfolio to say always pay off the non-deductible debt. It could be based on your circumstances, based on your scenario, and based on your goals. It may be more beneficial to retain the non-deductible debt. And by non-deductible debt, I'm not talking about cars and whatnot. I'm talking about your own occupied place. Retain that loan and pay out the income-producing loan. So then the thought process and objection comes up is that, but I'm going to pay tax. Got newsflash. When you go to work, you pay tax as well. So if you're buying back one day of your time, you'll still pay tax. It's just that the income's coming from a different place.
Yeah, that's a good way to frame it, isn't it? Reshmi?
Yeah, absolutely. Yeah.
So our last miss the bust then is around SMSFs, Victor.
You're giving me my soapbox again.
There's a Victor.
No, there were a couple of things that we were talking about. Oh, you will bring this example and that, and it's like, and then when you threw it to me, I'm thinking, oh, okay.
This is more of a soapbox moment. Now, first of all, if you're setting up an SMSF and all that, do it under advice, not recommendation. Right? Big difference. Hang on a sec,
you got to explain that.
Okay. You've got a lot of buyers agents, property advisors saying, next step is set up an SMSF.
So when you run out of serviceability over here, next step is SMSF.
SMSF, Got merit. Yeah, absolutely. And I'm a big advocate of that. However, get the advice first before you set up any entities to know what you're getting into and know whether it is right for you. So see a financial planner, see an accountant. Don't just work off the recommendation of your property advisor, right? Because they're going out of their space in that sense. So if you look at how SMSF loans operate, a lot of advice and again, this is from accountants and financial planners as well, right? Like I said, I'm sticking my neck out today. This comes from financial planners and accountants in the sense that they'll ask you to put a 40% deposit.
Yeah.
Now let's understand how loans work in a self-managed super fund. Once you take the loan out, you can't increase the loan. So it makes more sense to pay the slightly higher interest rate in the beginning years and get to 80%, so you're only using 20% deposits, plus the holding plus the closing costs.
Yeah.
So you've still retained a lot of your cash component within the fund, and therefore you can then implement more strategies, whether it's getting into shares, whether it is getting into more properties, or whether it is working on the property that you've got. Because within a year, 2 years, if it's a growth asset, you can go back to the bank, and similar to the strategies we discussed earlier in terms of cross-securitization, you can go back to the bank and say, hey, Mr. Bank, revalue my property. I know that you can't increase the loan. Revalue my property, and I want you to recognize the loan-to-value ratio and therefore drop my interest rate. So you'll get there within the next, say, 2 years, but you've now retained a big portion of your cash component in your fund, and you haven't locked that money away.
Assuming that you deploy the money you didn't use as a deposit in the right way to be
correct,
asset capital conducive, right? Positive, where that's okay. So the point being then you want to maximise the LVR at the highest possible.
In the initial stages.
In the initial stages of SMSF, even though you may pay a premium on interest rates, but noted that as well as the rent that's coming in to the fund based on the property, you also put in your contributions in there as well. So you can cover that cash flow.
There's strategies like that you can utilize your SMSF a bit more than what people are talking about, just buy a property in SMSF. Yeah, you can buy it, but there's more to it than that.
Yeah. And if you link it back to principal and interest only scenario, at 80%, most lenders will get you into principal and interest in an SMSF. So this is where you're actually paying principal and interest to get that higher loan amount.
Yeah. Okay, mate, we've covered a lot there. I've learned a lot. Thanks, gang, for coming in. A couple of things here I'm thinking, I could probably deploy that. That sort of makes sense. So I like I was sort of familiar with it, but maybe not as deep detail as going P&I straight off the bat in order to get a higher LVR.
Yeah,
that's sort of
that's a good one. The portability,
for a point, yes, and the portability as well. It all works really well. So design your decade. So everything we've been talking about over the last 8 to 9 months is contingent to your ability to be good with finance.
Correct. Yeah, that's your
the
fuel.
Fundamental thing.
That's your fuel.
It's a game of finance.
It is very much so. Yeah, property is just a vehicle.
Yeah. You guys seem really informed about it. Your deep knowledge around finance. I guess you've been doing it for some time, so it probably
been around the sun a few times.
Yeah. Okay. Do you think lending's that different these days than what it used to be?
No, it goes through its ebbs and flows. There are years where you could qualify, banks will throw money at you. There are other years where APRA may step in and,
when they move the
comparable rates.
Assessment rates and stuff.
And they put sort of handbrake on in there in 2017. APRA and these things that'll happen again.
It will happen again.
It'll happen again at some point.
If we can think of it in terms of right now, we're trying to bolster up the market with rate cuts, and we can't go too far with it, and it starts getting a runaway in terms of market heating up. Then APRA would step in. But right now, if we cut and cut and cut, it becomes too overheated. So the next logical thing, once we get this next round of cuts, is that APRA may step in and say, you know what, the assessment rate for homeowners as opposed to investors will be this. And investors may have a little bit more stricter lending criteria, or they may open it up to say we're back to the 1.75 assessment rates.
Good. Okay. There's a lot there. Who can actually provide you advice on all this? Because this is really who should be the custodian of the advice you're getting here? Is it your accountant? Is it your financial planner? Is it your mortgage broker? Is it your property advisor? You still need to make a call yourself, but there's some pretty sophisticated concepts we spoke about there.
This is a roundtable advice. So you need all your advisors on board and singing from the same page to be able to get the best advice.
It's deep. So people want to tune in this and probably go, I didn't know that. I want to talk to you guys. What's the best way to track you down, Reshmi?
Oh my goodness, Victor calls that everyone can call in. So I guess you can call in 1300 302 166, or if you've got questions, it's questions@rightpropertygroup.com.au, or otherwise it's our inquiry forms on our website.
Yeah, very cool.
Yeah, preferably, and I've been in trouble for giving out the phone number because the phone rings a bit too much.
Oh, does it? So that's a problem, isn't it?
I know. Sorry, I'll take it back.
1-800-VICTOR.
I am called the chaos conductor in RPG.
Gosh.
Does he actually go to work anymore? I thought he was out swanning around all the time.
I don't know. Does he really work?
I pretend to work.
You pretend to work.
Yeah, pretend to look busy.
Yeah, sure you do. But no, very good. All right, lots there. Thanks, gang. Thanks for coming in. It's good to see you, and a very detailed podcast. And it should be a sage reminder to everyone just how important finance is. It starts with finance, ends in finance. It's going to be the heartbeat that sort of will shape your whole property investment portfolio and the way you go about doing it. So we'll get more of it moving forward. This is Design Your Decade, a special series of property investing insights of the Right Property Group. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature, does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you.